Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Tuesday. These are the stories that set your agenda. Tech stocks, power gains across Asia, extending a global rally fueled by bets the Fed will cut rates next month. We're going to get US retail sales and factory price data later today. Nvidia shares, though, slip on a report that Meta is in talks to spend billions on AI chips from Google, a potential challenge to the industry leader's dominance. And Russia and Ukraine exchange fire with heavy air raids on Kyiv and assaults on parts of southern Russia just hours after President Trump struck a positive tone on prospects for a ceasefire deal. European stocks eked out very modest gains by the end of the session yesterday, just 0.1%. The handover, though, to Wall Street was not reciprocated. You saw very strong gains for the tech stocks, the biggest rally, in fact, for US tech names in about 6 months' time. Upside of around 6% for Alphabet by the end of the close. Broadcom gained 11% by the end of the close. Micron was very strong as well. So across the board, you saw strength in the tech space if you carved out Nvidia. Tesla performed very well as well. Nvidia under a bit of pressure on this story around Meta and the potential deal with Alphabet. Today, European futures, though, not taking much of an upside from that story, pointing lower by around 0.2%. And, of course, the gains that came through yesterday on Wall Street were powered in large part by mounting expectations that the Fed will cut in December. FTSE 100 futures, as we lead up to the budget, of course, tomorrow here in the UK, currently a little softer by 12 points. S&P evenly is also down after the gains that came through yesterday. S&P 500 ended up around 1.5%. The 10-year at 4.03, a move of just 1 basis point on the benchmark. We did hear from Chris Waller pushing the case for a December cut. And now you have money markets pricing in almost a 90% chance that the Fed does cut next month. Euro-dollar at 115, Bitcoin at 88,000, just holding at that level. A little softer in the session once again for Bitcoin, down 0.8%. And gold getting a bit of a lift on these rate cut expectations at 4,147, up 0.3% so far in the session. Let's cross over to Asia right now. The benefits and the read across from the tech rally yesterday on Wall Street is being felt in Asia. Min Min Lo is standing by in Hong Kong. Min Min, what are you seeing across the Asian markets on the tech side?
Yeah, we are seeing the Asia-Pacific benchmark looking moderately in the green today. Could we show the benchmarks on the screen, please? And we are digesting a few macro stories, right? Of course, we have, as you said, the repricing of the Fed rate cut, providing a tailwind for Asian stocks. And we have Chinese markets also gaining on the screen here. You can see we have the Trump and Xi phone call this morning. The tone from both sides looking quite positive. We have President Trump saying the call was very good. And you can see the Nikkei is looking quite flat at the moment. The Kospi as well up by 0.4%. There is a tech story going on there, which I'll get to in a bit. But the big story in China is, of course, that Trump-Xi phone call. President Trump also made a phone call to Takaichi, reaffirming the strong relations between the two sides. That's helping to boost the Hang Seng. Nikkei is really affected by the tech story, which I'll get to in a little bit. But elsewhere, what else we're watching in China is the big earnings story coming out today. Alibaba, a corporate story that is potentially going to be a macro story, because if Alibaba beats expectations, that could really give the AI rally in China a leg up. And you can see we are about 1.5% higher ahead of the earnings. Xiaomi as well up by 4.5% after the founder Lei Jun had increased his stake in the company.
And Min Min, we mentioned at the top there, Nvidia shares dropping in late trading. On this report that Meta is in talks not to spend billions of dollars on Nvidia chips, but on Google's AI chips. What's the reaction been, the read across to Asia then?
Yeah, it's been pretty mixed. Because of the Alphabet story, we are seeing these Alphabet-related stocks here seeing big increases to the tune of about 17%, 14%, double-digit increases here. But on the other hand, we have SoftBank here declining about 10%. Now, you might be wondering, why is SoftBank declining when it has already dumped most of its Nvidia shares? But it's because SoftBank is still heavily exposed to OpenAI, and it's now about the battle between the TPUs and the GPUs, and increasingly there's speculation that maybe Alphabet's Gemini AI model could be stronger than ChatGPT, both of them running on competing systems, right? ChatGPT is OpenAI running on Nvidia's GPU chips, and of course Alphabet's Gemini is running on its own homegrown TPU chips. So the question is whether SoftBank has put its money on the wrong company here.
Min, thank you very much indeed. Question marks then for SoftBank and its exposure to Nvidia. On the back of that news, Min joining us out of Hong Kong for the reaction over in Asia. As we mentioned, confidence also boosted by expectations, of course, of a potential Fed rate cut in December. Traders now pricing in, at least on the mining markets, more than 80% chance of a US rate cut next month. Take a listen.
My concern is mainly the labor market in terms of our dual mandate. So I'm advocating for a rate cut at the next meeting. We're going to get a flood of data that's released. And if it's kind of consistent with what we've seen, then you could make the case for January. But if it suddenly shows a rebound in inflation or jobs or the economy's taking off, then it might give concern to at least, look and see or be more cautious. So I think just because of that, you may see more of a meeting-by-meeting approach once you get to January.
Well, that was Fed Governor Chris Waller. For more, let's bring in our executive editor for Asia Markets, Paul Dobson. So, Paul, we've heard from Williams, we've heard from Waller, we've heard from Daly. They are all making the case for a cut in December. The Wall Street Journal reporting that that is where things are starting to line up, that they're giving space for Jay Powell to push for a cut in December. What could potentially derail a move lower in rates next month from the Fed?
Yeah, good morning, Tom. Well, I think it's far from nailed on that the Fed will be cutting in December. Think back to earlier in the month when we heard from a bunch of policymakers who were saying they didn't even want to cut last time. Let alone are they convinced that December is where they want to go. So the jury is still out a little bit, but the market is definitely gaining more confidence in the idea that they will cut again. This chorus of speakers that you just mentioned kind of giving that reassurance to the market and seeing that pricing come in. Analysts or economists are similarly, more of them favouring the idea that the Fed will cut, fewer expect a hold, but there is a decent proportion there as well. The Fed's dilemma is, as Waller was saying, the labour market on the one side, the inflation picture on the other side. Is inflation too sticky to have much lower interest rates, or is the labour market deteriorating so fast that interest rate cuts are not only warranted but necessary? These are the things that they're trying to get to grips with. The problem is we're in this sort of data vacuum to a certain extent on both of those fronts. Figures coming out after the next Fed meeting aren't going to be much help to them. So they're going to have to feel their way through a little bit and do it a little bit on instinct as well.
Paul, talking of data, we will have, of course, retail sales data for the month of September, dropping later today. Producer prices as well, PPI out of the US. Where is your lens going to be? Where is Paul's scrutiny going to be of this data that we get out later today out of the US?
Yeah. At least we do get some information that will give us a little bit more clarity. But look, I think the retail sales is September, so that's quite a long way backwards, looking already into the third quarter. We're already a lot further beyond that. So it will be helpful, but not that helpful. We also get some consumer sentiment, which might give us a little bit more of a current read on things. And I think that these what the consumer's doing and what retail sales look like is important, because we're seeing an increasingly strong narrative about the idea that the US is in this kind of K-shaped economy or K-shaped growth at the moment, where the poorest people are not really feeling very well off at all. They're suffering and struggling. They're struggling with employment. They're struggling with paying back their debts. We heard from retailers when they were reporting their earnings that there's not a lot of demand or appetite, and that's starting to sort of spread even into the middle classes as well. And so, if the data do give us more of a sense that that's happening, then that may be one more cause that the Fed hasn't been talking about too much yet for them to think about cutting interest rates. So it will give us some helpful information. Might not be great news for some parts of the equity market, but it might be good news for interest rates if we do get some negative data there.
Paul, on geopolitics, we had this call then between Presidents Trump and Xi, the first time they've had a call since their face-to-face meeting, of course, in South Korea. It's apparently lasted for about an hour, and President Trump says he's going to be visiting Beijing, or at least China, we know, probably Beijing, presumably, in April. Has this been a catalyst for the markets? How significant is this? What are investors kind of making assumptions about when it comes to the US-China relationship at this point?
Yeah, interesting, isn't it? Because this sort of came a little bit out of the blue, and we don't have too much information exactly at the moment. So it helped the mood music, I think, for Chinese equities, but it's not the clincher here. You know, it's much more about that tech story and the growth story at the moment that's really been powering the moves. And you can see that US futures are down a little bit as well, so they're not getting a particularly big lift off it. I think, you know, if it speaks to this idea that the Taiwan question and the Japanese comments and the tension between China and Japan has gotten to a point where people want to try and find a bit of a circuit breaker or a way out of this. So after speaking with Xi Jinping, Trump also spoke with Japan's Takaichi, and you get the idea that maybe, you know, there's a little bit of a hidden message or a bit of shuttle diplomacy going on to try to, you know, bring things back away a little bit from where we are in terms of that escalating kind of rhetoric and actual physical moves as well on the defense side. So resolving that, actually, it would be helpful at the margin, I think, for markets, although they haven't particularly struggled so far or been weighed down by China-Japan tension. Nonetheless, you know, clearing the air would definitely be a positive, not a negative.
Executive Editor for Asia Markets, Paul Dobson. Paul, thank you. Let's bring you some breaking news right now from the banking space in Europe. ABN Amro, that stock is up about 90% year to date. The redhead across the terminal with an update from ABN Amro on the jobs front. They will be cutting 5,200 jobs by 2028. That is compared to 2024. So 5,200 jobs to go at ABN Amro compared to the 2024 headcount number. They also give an update in terms of their targets for return on equity of at least 12% in 2028. So they see a return on equity of at least 12% by 2028. That is the forecast. They see a cost-to-income ratio below 55%, and they see common equity Tier 1 ratio above 13.8%. Again, that is a 2028 year forecast. On the jobs front, interestingly, for those who are anxious about the AI impact, the 5,200 jobs that are to go, this is about creating efficiencies, they say. In a statement, operations are being simplified, driving efficiencies by reducing the number of legal entities, optimizing and digitizing end-to-end processes. Technology is central, with legacy systems being phased out, API use expanded, and AI embedded. That is a stock to watch today. Here's what else to think about today. At 7 a.m. UK time, EasyJet earnings will be breaking. We'll give you those numbers, of course, for that European airline. And later this morning as well, a gauge in terms of the AI progress over in China with Alibaba earnings. And, of course, their artificial intelligence prospects will be central to that. A lot of scrutiny on that one. And at 1:30 p.m. UK time, we're going to get that delayed September US retail sales print and producer prices or factory gate prices. So data out of the US, even though it's delayed later today. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to Day, B, Go on the terminal. In focus, question marks about Nvidia and its dominance. It has about 90% market share for AI chips. But has Google just made a bold move in terms of this potential deal with Meta? To what extent is Alphabet going to be chipping at the heels of Nvidia? That rivalry is in focus. Coming up, Kyiv under attack, Russia and Ukraine exchanging fire overnight. As US President Trump pushes for that peace deal, we bring you the latest next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. So, US Commerce Secretary Howard Lutnick says President Trump will decide whether to allow Nvidia to sell its more advanced H200 chips to China. Lutnick spoke with us from Brussels about the national security concerns surrounding Trump's decision.
That kind of decision sits right on the desk of Donald Trump, right? He's got Jensen from Nvidia, who really wants to sell those chips, and he's got a good reasons for it. There's an enormous number of other people who think that that's something that should be deeply considered. And the benefit that we have is we have Donald Trump in the Oval Office. He is going to weigh those decisions. He understands President Xi the best. He will decide whether we go forward with that or not. That's on his desk with lots of different advisors. The president loves to hear lots of different voices to make those kind of decisions, and he'll decide whether we sell those chips or not, and then we will go execute it however he decides to go forward.
There's a bigger question here, Secretary Lutnick, about what national security is. Is it more of a national security risk to give China some of these high-powered chips, or is it more of a national security risk to not have U.S. tech in China? Has your view on that changed?
Well, that's the question, exactly as well put and in front of the president, which is, do you want to sell China some chips and keep them using our tech and our tech stack? Or do you say to them, look, we're not going to sell you our best chips. We're just going to hold off on that, and we're going to compete in the AI race ourselves. So that is the question. It's in front of the president. He's going to decide. It's a really, really interesting question. He's got all the information. He's got lots and lots of experts talking to him, and he's going to decide which way he wants to go forward.
Secretary Lutnick, meanwhile, use of IEEPA for tariffs is in front of the Supreme Court. The feedback has been skepticism so far from many of the justices, conservative ones included. As this plays out, can you walk us through how you'd prioritize the different alternatives should the administration's use of tariffs via IEEPA get struck down?
So I was in the Supreme Court. I sat through the whole argument. The justices were tough on the beginning on the Department of Justice's, our person. But then they were much tougher on the other side, much, much tougher. So I left that day feeling very confident that we and the president was going to prevail on these IEEPA tariffs. So I think, you're hearing it from me, I think I was there in the courtroom. I heard it all the way through. I didn't sort of write my story halfway through. I sat all the way through to the end. The president's going to win that case because that makes sense for him to win. But I want to remind you, the president has lots of other authorities. He has 232s, he has 301s, he has 338s, he has a whole variety, 112, 122. He's got all sorts of other powers. And tariffs are going to be part of this administration going forward, but I don't think they're going to be necessary because the president's going to win the IEEPA case in front of the Supreme Court.
US Commerce Secretary Howard Lutnick speaking to our team over in the US. Now, for the latest on US-EU trade negotiations, let's bring in Bloomberg East Asia Government Editor John Herskovich. John, and meanwhile, we have these negotiations between the EU and the US, and that's why Howard Lutnick was on the ground in Brussels. Does it look like the EU is going to comply with these US demands to roll back some of its digital regulations?
We got some strong words from EU officials saying that these regulations are not on the negotiation table. So they're drawing the line. They're saying that they don't want to do this. But Lutnick offered a deal to roll back 50% tariffs on steel and aluminum, which have really affected a lot of members in the EU. I think that this applies to about more than 400 products across the EU which are being hit with these tariffs. But the U.S. stood its ground, and the U.S. has really tried for many months to get the EU to change these regulations on tech firms. These have hit some of America's biggest tech firms. The Trump administration sees these regulations as non-tariff barriers that are creating unfair obstacles to U.S. firms. So it's a point of contention. Lines have been drawn, and we'll see if there's any progress from now as to whether either side will blink in this situation.
Bloomberg's East Asia Government Editor John Herskovich. John, thank you for that update. Coming up, Kyiv under attack, Russia and Ukraine exchange fire overnight. That's as President Trump pushes, of course, for that peace deal. We'll bring you the latest next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Russia and Ukraine have exchanged fire overnight, just hours after President Trump struck a positive tone on the prospects of a ceasefire. Russia launching a wave of heavy air raids on Ukraine's capital, Kyiv, while the Russian Black Sea coast region suffered sustained suspected drone attacks. Bloomberg's chief Europe correspondent Oliver Crook joins us now with an update. Ollie, what is the latest on negotiations then as the two sides exchange blows once again?
Yeah, that's right, Tom. I mean, after those talks in Geneva, those 24 hours of frenzied diplomacy led by Marco Rubio, the Secretary of State of the United States, and Andrei Yermak, the sort of number two in Ukraine in Geneva, we have now sort of a new adaptation of that 28-point plan that ripped through diplomatic circles at the end of last week, something that is now apparently a 19-point plan. There were apparently a couple of different plans floating around over the last 24 hours. As you can imagine, Tom, the Europeans were trying to put forward a plan, but it appears that now it's this sort of 19-point plan that's sort of the living document that the United States is working from, and now is going to have to obviously take that back to the Russian side. The commentary from the Russian side so far is that the 19-point plan is a non-starter. We understand also from Zelensky, who briefed the people of Ukraine last night, as he does every night, that after the Geneva talks, that no longer the 28-point plan, many of the right elements have been taken into account into that framework. The action now turns to the UAE, where we understand Army Secretary Dan Driscoll, who has become a greater and greater protagonist in these negotiations, has met potentially already with Ukrainians, but more importantly will meet with Russian officials a little bit later today to get it past them. All of that being said, some of the most difficult points now in that 19-point plan, dealing with territory, some of the most most difficult political discussions have been actually removed from the plan and are going to be left for President Trump and President Zelensky to negotiate. And we understand from a Zelensky aide who I spoke to yesterday that could happen over the next couple of days. All of that being said, Tom, it seems pretty unlikely that this gets all squared and settled by Thanksgiving, which is this Thursday, which is, of course, Trump's initial deadline.
When it comes to pressure on Russia at this point, Ollie, because arguably the ball is moving back into the Russian court, what measures can the US and Europe exert at this point?
Yeah, so of course the sort of, I feel like a broken record bringing this up every single day. Of course, the Russian assets is the main lever of leverage that the Europeans have to exert on the Russians. They have failed to move on that as a 27-member state sort of unity. This is something that probably, again, I heard from the Lithuanian foreign minister yesterday saying that basically in a Trump world, you need to get your voice heard at the table by earning it, and the way the Europeans could earn it is by moving on those Russian assets. But we should say, Tom, we shouldn't lose sight of the fact that last Friday is when those Lukoil and Rosneft sanctions went into effect on the Russians. That is only beginning to hit the economy. That could have a major effect, but that again will be for months to come. And there is, of course, still that bipartisan Senate bill that is sitting with the United States. It is sitting on Donald Trump's desk. He just needs to pull the trigger, put it in front of the Senate and the House. That would likely pass, and that is the secondary sanctions, where the United States would impose 500% tariffs on anybody buying Russian crude oil, Russian gas. Those are the levers that the United States could still pull. And of course, the lever they can pull on the Ukrainians, which we've heard they've threatened to do, is to start to withhold military hardware and intelligence, which would be absolutely devastating to the Ukrainians. But those are the sort of stakes going into these negotiations over the next couple of days and what the United States and Europe can do.
Bloomberg's chief Europe correspondent Oliver Crook with that update. Ollie, thank you. Coming up, we're going to be discussing what tomorrow's UK budget could mean for the country. We're going to speak next to Laura Foll, portfolio manager at Janus Henderson, for a view on the UK equity space, how to think about positioning in and around that budget, which of course is tomorrow. That analysis coming up. Stay with us. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Tuesday. These are the stories that set your agenda. Tech stocks power gains across Asia, extending a global rally fueled by bets the Fed will cut rates next month. We're going to get US retail sales and factory price data later today. Nvidia shares, though, slip on a report that Meta is in talks to spend billions on AI chips from Google, a potential challenge to the industry leader's dominance. And Russia and Ukraine exchange fire with heavy air raids on Kyiv and assaults on parts of southern Russia, just hours after President Trump struck a positive tone on prospects for a ceasefire deal. Let's get to the markets right now. European futures looking a little soft, down 0.2% after some very modest gains for European stocks by the close of play yesterday. It was a stellar session, of course, in the US, with gains on the Nasdaq Composite of around 2.6%. The S&P 500 ended up around 1.6%. Tech, as a basket of stocks, the best day since around May. You saw gains of 11% for Broadcom, gains of more than 6% for Alphabet on that potential tie-up with Meta. It's not really giving much of a lift, though, to Europe at this point. Asian stocks have been up on the back of this story, particularly those exposed to the Alphabet story. European stocks, though, pointing low by 0.2%. FTSE 100 futures was we lead up to the budget tomorrow, pointing low by 16 points. S&P E-minis after the rally yesterday, a little softer by 0.1%, and the Nasdaq 100 futures pointing down by 36 points. Let's flip the board and have a look at the cross-asset board. US Treasuries relatively stable, yields up just 1 basis point after a move into the sovereign debt of the US yesterday on expectations the Fed will cut in December. It's not locked in yet, but we've heard increasing voices, of course. Chris Waller, the latest to come out and call for a December cut. 4.03 then, 4.03 on the benchmark 10-year. Euro dollar at 115. Bitcoin at 87,000, just crossing below that 88,000 level, down 1% once again in the session. And gold holding about 4,140 right now per troy ounce. The yellow metal up 0.1%. Let's turn our focus, though, to the UK, where markets, of course, are bracing for Chancellor Rachel Reeves to deliver the government's budget tomorrow. Laura Foll, Global Equity Income Team Portfolio Manager at Janus Henderson, joins me now with a lens on the UK and the UK equity space. Laura, good morning. Thanks for joining us. In the context of the FTSE 100 up 17% year to date, so outperforming the S&P 500, and yet the FTSE 250 underperforming significantly, up just 4% year to date. What would be a positive outcome for UK equities from the budget tomorrow?
So it's always going to be more material to the FTSE 250 because, as you say, that FTSE 250 is lagged because it's more domestic. So what would be a good outcome? I would say first and foremost, it has to be non-inflationary. So if we think back to the budget last year and the national insurance cost that was put on employers, the knock-on impact of that was that those employers then passed on those costs to the end consumer. Inflation was higher than it could have been, and so there was less of a path down for interest rates in the UK as a result. So I think the number one thing the market will be looking for is this non-inflationary and therefore allows that path of interest rate cuts that the Bank of England has given a steer to as we look ahead to next year. So that's the first thing. I think, secondly, it has to be credible. And what I mean by that is it has to raise what the government is forecasting that it will raise, and ideally sooner rather than later. So not towards the end of, say, the decade. The market will look for measures that raise money, ideally in the next couple of years, and that it will actually raise the money that's forecast. And finally, I would like to see, and I think both equity market investors and gilt investors would like to see, that it's non-distortionary. And what I mean by that is it doesn't put a heavy burden on particular subsets of individuals and companies to the extent that it changes behaviour and also perhaps doesn't raise, again, what it's forecast to raise. So those are the three things in the front of my mind.
If we get a budget that does not involve an increase in income tax and is a smorgasbord of tax increases, as has been signalled, does that remain a credible and non-inflationary budget? Does it remain credible?
I think the nice thing, if you want to call it that, about the income tax rise before there was the U-turn, if that does end up being correct, is that income tax would have fulfilled those three things. It would have been non-inflationary, it would have been non-distortionary, and it would have been credible. So that's why the market reacted. It might seem counterintuitive, but the market actually reacted positively when it was income tax rather than, as you say, this smorgasbord. I think the path is narrower. If you're going down the smorgasbord route, the path to fulfilling those three things is more challenging because you're, by its very nature, relying on a large number of smaller taxes, but smaller taxes that will have to raise a fair amount, given that we're probably talking about 25 to 30 billion that needs to be raised. That's quite a lot of these smaller taxes. So I think from an economist point of view and a market point of view, that's not ideal. You're more likely to drive change incentives and change behaviour and therefore not potentially raise the amount of money that you wanted to raise.
Has the lead up to the budget and all of the leaks and U-turns, possible U-turns, has that already damaged the credibility of this government?
I think to an extent, yes. And I think the other thing that you've seen is that some companies already have come out and warned about the knock-on impact that they've already seen in the real world. So, for example, the likes of ITV has come out and said that Q4 advertising has been weaker than they think it would otherwise have been. You've seen some of the house builders like Taylor Wimpey and among others come out and say this has impacted demand because consumers, completely understandably, are delaying big decisions. So there have already been real-world impacts of this, budget bingo or whatever you want to call it, that there's been kite flying, across the summer.
And you touched on a couple of sectors there. Is there a particular sector that stands out in terms of a potential vulnerability or potential upside as to what comes out of this budget?
I think it's been clear that property taxes will form part of this smorgasbord. The exact mechanics of that haven't yet been made clear. But house building was one of the areas that Labour mentioned in its manifesto last year, really centred in on. And I think property taxes, they will form part of it. And so I think for me, as an equity investor, I'll be paying particular attention to the form that property tax takes. It seems to be, if you're to believe the recent press, it seems to be in the form of higher council tax, which could potentially, gum up, for want of a better word, the higher end of the property market. But what it will be interesting to see is whether that's offset in any way at the more affordable end of the housing market with any kind of stimulating measures to boost demand.
Reports today that the banking sector will get a reprieve from higher taxes. Is that already priced into the UK banking basket, or is there an upside there if that does materialise? I
think if there is any upside, it's pretty minor. As I'm sure you know, the banking sector has performed incredibly well this year on the back of coming back to that NIX increase and inflation staying higher for longer. UK interest rates have stayed higher for longer. That's definitely already boosted banking sector earnings. So banking sector profitability is already relatively high. Valuations have moved up. I think if there is to be any benefit, it would be pretty minor in terms of bank shares.
You started by talking about the importance that this is a budget that is non-inflationary. That's what you want to see, and you tied that, of course, to the rates outlook. Yes. What is your current? I mean, of course, this could very much change in the next 48 hours. What is your current estimation? Your current kind of view on how the Bank of England responds in the months ahead, looking into 2026? What is your base case at this point?
Sure. Very willing to be proved wrong in the next 24 hours. I think, on balance, I think interest rates will be cut in December. So if we look at labour market data, I know there's been some issues with necessarily the accuracy of some of that UK labour market data, but it does point to a job market softening. We've seen unemployment tick up. We've seen wage settlements still above the 2% that the rate target is, the inflation target is. But I think it has paved the way, provided that there isn't any inflationary impulse in the budget tomorrow. I think it has paved the way for the Bank of England to do a 0.25 percentage point rate cut in December. And then I think as we look ahead to 2026, you're probably talking about another gradual pace of interest rate cuts. So perhaps a terminal rate of, say, 3.5, perhaps 3, but just that path of gradual rates down as we look ahead to next year.
And is that view on the direction of travel for interest rates here in the UK making an assumption about the smorgasbord of cuts, or is that making a bolder assumption that maybe she will do a U-turn on the U-turn and raise income taxes? What assumptions are you making about taxes in that view?
What it assumes is that there isn't an inflationary impulse in there. So what it would assume, for example, is that there isn't, say, if we go back to a couple of months ago, one of the things that was being speculated on was a VAT increase. That would be inflationary.
Yeah.
So it would assume that they don't go down that route. Now, it doesn't necessarily matter whether it's the smorgasbord or the income tax route, as long as none of the smorgasbord are inflationary and that they are seen as credible by the markets.
I want to go one more sector before we let you go, which is the retailers.
Yeah.
And some of them have had a pretty good year as well, despite the cost pressures. Tesco coming out with some decent results. We know that's been part of the conversation, according to reporting in the Treasury, as to whether or not they have scope then to raise business rates on some of those big retailers. How much of a, can they look through that? How much of a challenge would that be to the retailers if that came through? High rates on some of the big box retailers here?
I think it would be frustrating for the retailers to see business rates go up. If you think for the likes of Tesco, Sainsbury's, M&S, they've had things like the packaging tax put on them. They've had, obviously, NI, national living wage. The cost inflation that they've already seen as that subset of retailers has already been substantial. So I know that there's been some pushback from them about the business rates coming on. We ideally, I say this as someone that owns Tesco, Sainsbury's shares on behalf of my clients, they've done very well in terms of managing those costs. I think it would be frustrating to see extra costs put on them that would then ultimately probably end up in consumers' pocket as well.
OK, Laura, thank you very much indeed. Really great setup ahead of the budget, of course. Laura Foll, Global Equity Income Team Portfolio Manager at Janus Henderson, looking for a budget that is non-inflationary, credible and non-distortionary. Now, some other stories making the news this Tuesday. Apollo Chief Executive Mark Rowan has rejected the notion that adding private assets to retirement and insurance portfolios can pose a systemic risk. During a presentation on Apollo's retirement services business, Rowan said, quote, "People have really just lost their minds, and the headlines get more and more hysterical." Hopefully not from Bloomberg. Rowan told investors that most private credit held by insurers and pension fund buyers is rated investment grade. And today's Big Take looks at the topic of trade and whether President Trump's claim of $21 trillion worth of investment pledges really stack up. The short answer is not really. You can read the full story on the terminal and on Bloomberg.com. All the analysis, data and graphics around that story. Well worth your time. In other news, a federal judge has thrown out criminal charges against former FBI Director James Comey and New York Attorney General Letitia James. The judge ruled that the prosecutor who brought the cases had been illegally appointed. President Trump abruptly installed the prosecutor in September after her predecessor resigned under pressure to bring charges against the pair. Comey and James are among a group of Trump's perceived political foes who have faced investigations after the president called for their prosecution. European car sales climbed for a fourth straight month in October as the nation's or the region's automakers continue to push out more affordable electric models. The European Auto Manufacturers Association says new vehicle registrations rose 4.9% from a year earlier to just shy of 1.1 million units. China's BYD saw sales in the region more than triple, easily outstripping Tesla, whose sales continued to slump, with registrations down 48%. Bloomberg understands UK government ministers have approved London Heathrow Airport's £49 billion proposal to build a third runway. UK Transport Secretary Heidi Alexander is expected to announce that decision today. Sources say ministers backed the more costly option, which will involve moving the M25 motorway. That plan has come under fire from major customers, including British Airways and Virgin Atlantic, which argue that the hub is already expensive to use. Coming up, Funding Circle CEO Lisa Jacobs joins us to discuss the likely impact of tomorrow's budget on British business. We have that interview for you. More analysis in the lead up to the Chancellor's budget. Stay with us. This is Bloomberg. Welcome back. Investors will be keeping a close eye on the gilt market tomorrow, of course, as Rachel Reeves makes her much-awaited UK budget statement. Bloomberg understands the Chancellor will slash the amount Britons can save in their tax-free cash ISA saving accounts each year from £20,000 to £12,000. That's the cash component. We understand the move is a bid to get households investing more in UK stocks. For more, let's bring in Anna Andrade from Bloomberg Economics with some of the details and the potential implications. What do these ISA changes mean, Anna? We assume that the total cap is still 20,000. It's just that the cash component is 12,000, so you're compelled to put the extra 8,000 into equities, but not necessarily UK equities. Is that correct understanding?
Yeah, I think those are the broad contours of it.
Yeah.
I think from a public finance perspective, this is part of sort of a broader move of Reeves to sort of try to raise revenue anywhere she can outside, you know, the biggest four tax streams. So these include income, corporate tax, NICs and VAT. So she's clearly trying to do her best efforts to sort of keep the manifesto, Labour's manifesto. I think I would say there's like two problems with these sort of moves and, you know, going a bit after savings, a bit after pensions, is that the tax base is much narrower. So she actually needs to do bigger policy changes to yield any sort of significant revenue, and that will only yield a few billion. And then there's a lot of uncertainty about the sort of the revenues it will generate, because people might just stop saving into cash, as you said, and so then, you know, there's not that much revenue that will sort of come from that. So in a way, it's a bit of a risky move, I would say, to sort of rely on this sort of going after savings, pensions to sort of fill a hole that's as big as 30 billion.
Does that keep the bond vigilantes on their toes then? How much of a risk are the bond vigilantes tomorrow?
I definitely think the composition will be the composition of the savings, of how she fills the hole, of how she gets to sort of this 30 billion, if that's the right amount, will be something that the bond vigilantes will care about. I mean, the income tax has been ruled out, and the risk that she relies on these sort of small measures, it means that, I think it means uncertainty about the exact revenues she will get, but I also think the other thing that the bond vigilantes will be looking at is the profile. So if she does the fiscal tightening sort of in the next few years, that means, that the revenues will start to come in quite soon. But if she backloads the fiscal tightening, I think investors will start questioning, are they going to follow through with those changes, because 2029 is an election year. So, they might discount a bit of that as well.
Anna Andrade from Bloomberg Economics, thank you very much indeed. And that brings us to our next guest, Lisa Jacobs from Funding Circle, for a view on what is needed around SMEs, small, medium-sized enterprises, of course, under pressure, given some of the economic challenges here in the UK. Lisa, let's bring you in at this point. What would you like to see, and your members, your customers, I should say, like to see from this budget?
I think it has been a really tough time, like you say. Our small businesses are finding the environment quite tough. But what they really need to see is that stability, to see that long-term stability that gives them the encouragement to want to invest over the long term. The government has said before that they should have one budget a year. I think that would be a really good start for them to focus on.
How much has the instability that we've seen leading up to this budget put a dent on the animal spirits of the SME space up until now?
Yeah, I think if I look back over the last 10 years, actually, it's been a difficult time to run an SME. And when I speak to my customers, they say, we've had Brexit, we've had COVID, we've had the cost of living. They've built the resilience into their businesses. They've built the resilience into how they run it. So I think it has been a distraction. And they would much prefer to be focused on running their business. The average small business we support, they're about 10 employees. The person who's running that business is doing the sales, the marketing, the finance. They want that certainty to enable them to continue to run their business.
So what amongst the policies that have been floated so far have been most encouraging or most concerning for your customers?
I think the one that we think is a really positive move would be to support businesses with business finance. There is a growth guarantee scheme in the UK. It's working really well. That should be expanded. It's about a quarter of the size of the equivalent one GDP adjusted in the US. Because when we see that businesses get finance, they go on to invest in their businesses, they employ people, and they continue to grow and support GDP. So we think that would be a really important move in the budget.
What are you able to give us approximate proportion of your customers that are holding back on investments at this point? Need that stability, need that clarity before they pull the trigger on investing?
Yeah, we've got actually a really big range of small businesses that we support across the country. So we've got fine art foundries in Edinburgh, we've got chocolate manufacturers in Somerset, we've got furniture manufacturers in the Midlands. And so actually they have varying different degrees of investment appetite. Some actually are thriving in this market. They're finding confidence is good for their segment, particularly those who serve an affluent base. And others are holding their nerve a little bit and working out what's coming up in the budget.
Oh, interesting. OK, so businesses that have exposure to higher-end consumers are faring well in this environment.
I mean, we have a restaurant business here in London who their customers come once a year for a treat, and so they've been able to pass through prices, continue to grow their business.
What are the biggest funding challenges, and what's needed to widen the access to funding for SMEs in the UK?
So I think actually over the last decade there has been a significant increase in the competition in the market, the choice for small businesses. We now find that over 60% of funding to small businesses is coming outside of the traditional high street banks. So there has been this change. 60%, that's correct. So there has been this change. We have originated over £16 billion now to 110,000 businesses. So I think two things. One is awareness of these alternative sources out in the market for small businesses to get funding. And then the other thing is this, on the demand side for small businesses to want to invest in their business, to continue to want to invest in their business. And for that, they need this stability. They need to be able to see a 5-10-year horizon where they can invest in their business.
Our previous guest was talking about the fact that she wants to see, from the equity investor perspective, a non-inflationary budget. To what extent are your customers absorbing costs up until this point, whether it's national insurance or input costs, or passing that on to the consumer? What is that dynamic looking like?
Yeah, we see them doing a bit of a combination of both, actually, and also, importantly, innovating around their products. So we have a chocolate business in Somerset, and actually cocoa prices have increased significantly over the last year, almost doubled. And one of the things that they've been doing is expanding their product set, thinking about how do they use different sources of confectionery in their products, how do they expand beyond just that chocolate. And so what we see is this continued innovation, continued resilience happening in small businesses across the UK in order to counter those cost prices, whether that is in raw goods or whether that is as a result of policies.
Lisa, great perspective. Thank you very much indeed on what the SME space of the UK needs from this budget tomorrow. Lisa Jacobs, CEO of Funding Circle. So, UK Chancellor Rachel Reeves, of course, will deliver that budget at 12:30 p.m. in London tomorrow. Viewers in the UK and Europe can join us for full coverage and analysis as it happens. It doesn't stop there. The opening trade will break down the numbers with key business and political voices in its budget special the day after, on Thursday, of course. There's a lot more coming up. Stay with us. This is Bloomberg. Welcome back. So a decent session overnight on Wall Street, the S&P 500 gaining around 1.5, 1.6%. Importantly, for those technical analysts out there, breaking above its 100-day moving average, and comfortably so. 6,552 is the 100-day moving average. The S&P 500 ending comfortably above that at 6,705. The next level then is the 50-day moving average, 6,713. If we cross that level and remain above there, maybe that is a further support for the S&P 500, particularly as these bets around a potential Fed cut in December continue to mount, given the commentary we're hearing from FOMC officials. We know the debate continues to be live, of course, but money markets pricing an almost 90% chance. So, above the 100-day moving average, the next line to cross is the 50-day moving average for the S&P 500. Watch that today. Let's flip the board and have a look at what happened in the tech stocks yesterday. A very, very powerful rally indeed for the Mag 7 names. And that crushed volatility. It fell to 20, so just above 20 in terms of the VIX index, as Mag 7 stocks gained, particularly Alphabet, up around 6% by the close. You also saw Broadcom closing higher by around 11% as well. Nvidia, of course, challenged on that competitive threat from Alphabet. But again, volatility has been squeezed lower as a result of that. Talking of Alphabet, this is now a clear leader in the AI space, given its dominance across the stack, from data centers to chips to the product to the models. The Gemini 3 model has been very well received. The gains, more than 70% year to date for Alphabet, just outstripping its competitors by a long margin when it comes to the likes of Meta and Microsoft and Amazon. Meta up just shy of 5% year to date versus 70% for Alphabet. Coming up, we will be speaking with EasyJet's CEO. That's coming up. The Open Traders next. This is Bloomberg.